All right, and we're recording. Cool. All right, guys. So the purpose here now is to talk about investing in the equities markets. So I know a lot of you guys have those curiosities, but let's start with Dennis. Is there any specific thing that you are curious about, or do you have a method of doing it that you like to share? I have a method. I have a way of sharing, but let's see where we stand to begin with.
I don't. Just want to know how you're doing in general.
Okay. Anyone else here got any specific things you want to address about the investing world? Good old Vu for Tarek. Vu. That's the S&P. Yeah, keep dollar averaging. Okay. All right, that's a good starting point. Yeah,
How to
that's
make money to invest.
what, sorry? You have to what? I lost
How
you.
to make money to invest at the first
You have
place.
to make money. Yes, that's a good point. That's a good place to start as well. Have money before you think about investing. Okay, so here. Um, the way I do it is the way I do everything 80/20. Very simple. And for me, the most fundamental thing about making money and freaking anything in this world using 80/20 is asymmetry. You risk a dollar to make $5. So it starts with that. Day trading as well. You guys see me day trade, I do the same thing. So now if you're looking at something like this, the SPY, you know what, you guys can see my screen, right? I see it. Let me get the real data out here and see what I can do for you. There we go. Okay, let's go to a weekly chart. Makes life a little easier. Back in 2021, basically, if you had kept buying the SPY, you'd probably get up there. You're making money. Overall, in my opinion, this doesn't beat inflation. Also, like I was saying, 80/20, it's not asymmetric. I mean, what's your risk? Where's your stop? Is it all the way zero, or do you have a place in mind and then you're looking to go 10R from there? That's why I don't invest in the SPY or such things. That's why I can't look at this sort of thing or anything in the popular broad market. I struggle to find the asymmetry here. The way I find asymmetry and the way I've learned to do it from this other group that I'm with, day trade, not investing group, is by going contrarian. So not looking at the broad market. So you're looking at sectors and industries and even geographies that have been totally broken down, beat up, left for dead, treated as toxic waste by the world for the last, I don't know, 5 years, 10 years, to the point where you never talk about it anymore. I mean, has anyone talked about Venezuela recently as a place to invest, or Argentina, and then since 1995, for example? Would you put money in Argentina? Look at that inflation, crazy stuff. How about Egypt? Egypt's market's been crazy, right? Well, how about India? There's another one. But again, this is all contrarian thinking. You're going the opposite direction of the SPY, essentially. And that's one thing, is geographies. The other thing is sectors within the SPY, and there's so many. Gosh, I think XLF is that the finance sector? I can't remember. XLF is the SPY has how many sectors? I think 8. So there's the finance. Thanks, Tarek. So there's energy, finance, industrials, technologies. I don't even know. Whatever. What I'm looking at is when you look at the makeup of the SPY, you're gonna see what is the smallest makeup of the SPY, and you're looking at it broadly the last 10 years. And what has been dying? What has been decreasing? Recently, by recently I mean let's say since 2010, we have tech stocks, Mag 7, right? All dominating, taking over. So something's been left behind. What's that? Well, you look at the various sectors, and it happened to be XLE, which is energy. Now, this is an interesting chart. Hold on real quick. There's a day trade happening here as well. I might get into a position. 644, 645 contracts. Okay, I'm just going to keep this ready in case it breaks out. I'll look at it. Now, broadly, if you look at what happened with the energy sector, XLE is energy and more traditional energy. We're talking about oil and natural gas and coal, all the stuff those greenies don't like, right? Save the planet, all that rubbish. This is the stuff they don't like. And sure enough, it's been going down. Sure enough, if you investigate further, there's been mergers and acquisitions and bankruptcies and all kinds of things in let's say offshore oil shipping, offshore oil drilling, and those companies that own the helicopters that charter these helicopters to go fly back and forth from those offshore oil rigs. For example, like, you can go into the sector. There's so many different areas in the sector. So if you look at that, there's all of these bankruptcies and destroyed, and what's left is a few companies that are completely consolidated. They've been through bankruptcy, they survived total debt restructuring, all that stuff. Now they're full of assets and full of cash and no debt, and they're monopolies because, well, no one's left in the space. And go to a bank and try and borrow $500 million to open up an oil rig. You think a bank's going to want it? The bank doesn't want to be seen as supporting dirty energy, right? Go and try it. So there's no new businesses coming online also. And of course, their stock prices have been totally beat down. They've had structuring and bankruptcies and all that. And then if you look even further at these few companies that are left, you'll find that they may have, let's say, $100 million worth of assets. They have ships and buildings and whatever. And if you go and look at their share prices, they're selling, $2 a share or something. You put it all together, just to be at net asset value, there should be selling at $10 a share. So for effectively, you're buying their assets at 20%, at an 80% discount. Just 20% of net asset value. So that itself that's what Warren Buffett calls the margin of safety. I mean, that itself on its own is massive, and it's not like anything has to change, except people have to realize, like, the company actually, if it liquidates today, it's going to go at $10 a share, because that's what you'd sell all these assets for. That's what they're approximately worth. But on the market, it's $2 a share. Now look at that asymmetry. Let's say your stop is 0, and you calculate net asset value as $10 a share. I mean, look at that upside. That's 5 to 1. Straight and simple, right? So that's my process. That's my thinking. Now, when you go and find these industries, these sectors, these geographies, and then you find specific companies to invest in, there's two things that you got to do that most people are just simply unwilling to do. So this is the harder part. One is you got to give it a lot of time, because you buy this thing at $2 a share. A week later, it's going to be at 80 cents a share. Then 6 months later, it's going to be at $4 a share. Then it's going to be back at $2 a share 6 months, a year later, whatever. You got to stomach all that volatility. You can't be looking at it every day, every week, every quarter. Forget it. This is where you need to have money, right where we started with. Money that you don't need for the next 5 years, or money that if you lose it today, you won't miss it. Put it in there. Put in your $1, and if it turns into 5 or 10, great. If you lose that one, you're not going to miss it. That's how I structure my portfolio. And so you're giving yourself an opportunity to get lucky, put it that way. And you don't just buy one company, buy a whole basket of offshore oil drillers, or these companies that survey under the ocean, and they have all these ships that survey under the ocean, or coal miners listed on the Australian exchange, or things like that. At one point, I bought a uranium miner that mines somewhere in Africa, I forget, and they're listed in Vancouver. I think in Vancouver. A lot of these miners are listed in Vancouver. So you see now the asymmetry. So one thing is you got to give it time. So and here's what we always talk about in the investing world. Look at that, the SPY dropped. What we talk about is the big advantage that a retail investor has that the hedge fund manager does not is actually time, because the hedge fund manager has to show performance every quarter, and if they underperform the S&P 500, they're going to have their investors pull out, all these redemptions, and it gets complicated. So they're very, very cautious. They can't really go and find these massive asymmetric setups and just hold it for 5 years and forget about it. Like, hold a basket of them, 3 of them go to 0, 3 of them go 5x, 10x. I mean, how do you think I bought Bitcoin at $3,000 and sold it at $60,000? It was the same thinking. If I lost the 3,000, it didn't matter. But, it didn't. It went the other way. It went all the way up. But I bought a basket of crypto at the time. Bitcoin was the heaviest one, though. And the other ones that actually did go up as well went up more than Bitcoin. They were more volatile. So that was all back about 10 years ago. So you got to think of it that way. You got to put time on your side. You got to stomach that volatility. And you really got to, before you put the cash into it, just tell yourself, this is cash you're not going to miss. Leave it alone. And don't treat investing as a way of making money. Investing happens after you've already made money, and now you can allocate. This kind of investing. Okay, I don't see it as it's not an income generator. It's money that you can put aside. Now, to put time on your side, you cannot use leverage. You cannot use options because options, by definition, expire, right? There are ways to do it, but realistically, you're buying companies at $2 when they should be at $10 just on net asset value. It's like buying an option for free, or rather, it's like buying an option that never expires. Isn't that cool? I've got like 10 of these in my portfolio. So that's the thinking, and that's the 80-20 thinking. And it's been, for me, it's been tremendous. It's been huge. I've been doing this since longer than I've been day trading. And yeah, when I was blowing up day trading accounts 5 years ago and didn't know where to get money from to fund it, well, it turns out my investment portfolio was through the roof. So I could, take little bits out of there and refund an account and learn to day trade again. That's how I survived the day trading learning curve so far. So that's it. That's my whole webinar on investing. That's how I do it. And don't think I'm going to go and research industries and companies and geographies. No, I just buy the newsletter. I pay the annual fee and I'll read the newsletter. And if it makes sense to what I'm thinking, okay, I'll investigate further and maybe I'll allocate some position to it. And remember, it's all fundamental analysis. I don't give a crap what the chart looks like. The monthly chart, yearly chart, candlestick chart, whatever. To me, that's all rubbish. It's fundamental analysis. In this 5-year, 10-year picture, I'm not looking at candlesticks. I'm just looking at the value of the company, the whole positioning of the sector, everything we discussed, the whole broader theme, and then I'll buy the damn thing. Let me think, what was the other one? Oh yeah, we have. So for now, where I'm in is basically all energy, offshore shipping, Argentina. For now, I mean, I've been accumulating this for the last 10 years and it's been crazy. Uranium's been big. All that stuff's still going. Crypto, I'm out of it. I was out of it a few years ago. It's too dangerous now. And all these various things. But there's people out there who do all this kind of research and you can read their newsletters. And that's what I do. I'm not going to sit there for hours and hours and go to investor meetings and forget about it. And that's not 80-20. 80-20 is take 1 hour a week and read an email. And that's all you really need. Anything beyond that is just mental masturbation. You don't need more than that. And that's it. Any questions, anyone? That's the whole webinar. I have nothing else to say in investing. Oh, look at Apple. There it goes.
Avi, do you recommend a newsletter or some kind of service? Because some of them, they're just like full of,
Yeah.
I tried a couple of them and they're like, this is the worst advice anyone can give.
Oh yeah, no, it's horrible. There's a lot of crap out there. Listen, I've gone through so many as well. There's one that I stick to generally nowadays. I know the guys personally as well now. I mean, it's been years and we keep meeting up in various corners of the world and discuss these things. Yeah, send me a private message. Whoever wants to know, I'll send you the link to their service and you can investigate if you like it. Those are the guys that I primarily pay attention to. And yeah, I'll share that with you. No big deal.
Thank you, Avi.
Mm-hmm. Sure.
Hey, Avi, thanks for sharing. That was really great.
Sure, man. Sure.
I just wanna support your thesis from an industry perspective. I've been in oil and gas for 21 years now. Literally lived and worked in 3 different continents across the globe. So one of the things which I can laugh about, right? I mean, if you look at the entire stock market, energy is only 3% of it, entire.
Yeah.
I mean, only NVIDIA is more valuable than the entire energy sector right now. The question is, if you take this 3% out of there, the rest of 97% will collapse. So you're absolutely right. I can say it with what I see every day, that energy is one which we will need more and more. We are literally deficient as humans. We don't have enough of it. And that is very evident if everybody sees their electricity bills across the globe. I mean, US has increased almost 40%. I mean, Europe has increased almost 60-70%. And Germany is the worst with 150% increase in electricity bills. I mean, Africa and all those countries don't even talk about it. They are in 300-400%. They don't have enough. They're all tapped out right now. So you don't have so much energy like in US. Our refrigerator in our house, what it used, the entire continent doesn't have enough of that. So point is that more energy will be required. And I think you're absolutely right. I 100% agree with you. And I can tell you as a driller, the wells are getting very, very complicated, very, very complicated. It's not easy. And these narratives which are built all over the place, where these big investment, companies push with DEI and environment and all that nonsense. It's crazy. It's honestly totally crazy. Sometimes I get shocked. That's like, seriously? I mean, I live in Texas, and sometimes, we are not on the national grid. We are a completely different grid, but still we get brownouts. California is getting brownouts in all these places. So yeah, you are absolutely.
Yeah.
So I agree with you 100%. I think energy is, for me, it's number one, and second is the input material, right?
It's all the whole sector. You need these big rigs that can drill. You need the big trucks. You need the diesel to run the damn trucks.
Right. Yeah.
Shit. There's so much in it, and people are saying we're going to run everything on batteries. You know what? You need drills to freaking drill under the earth to get the lithium to make the batteries, and there isn't enough lithium, by the way, to have all electric cars on all the streets all around the world. Are you crazy? And you know who mines these things? Slave labor in Africa. Those kids who get beaten up. Tell the greenies that about human rights, and I'll tell them that's what they're supporting, really. And these wind farms. How many eagles get killed with wind farms? What do you call those things called windmills? Have you seen what a solar farm looks like compared to? It destroys the landscape completely. It destroys everything. There's solar farm. Look at a real big solar farm, and you're looking at one oil rig, which was far more efficient at producing energy than a solar farm, an offshore oil rig. I mean, shale oil we know is pretty much at its peak. The peak is past. But anyways, I'm agreeing with you. All this stuff is I read this in the newsletters as well.
No, I support. I mean, you do this. I mean, I'm in the industry, so I see this. I absolutely agree with you 100%. I think. I mean, if I look at XLE, like for example, you showed, right? This looks like it's something which tech was back in 1990s.
Yeah. XLE is something else, man. I'm telling you, I started accumulating XLE in like 2016, I think. I don't even know when. It was about, I remember it was like $20 a share. Look, it popped up close to 100. Now it's sitting about 90. Gosh.
And these are cash cows, right? I mean, if you look at these companies, their P is really low, and they're cash cows. They're literally cash cows.
They are.
And every time what happens, like for example, these days we are under a lot of pressure, right? So there is a tremendous consolidation is happening. A lot of companies are gobbling here and there. More companies are coming together, becoming stronger and bigger, right?
Yep.
And it's perfect time. This is just consolidation. As traders, we know when consolidation happens, it breaks out after that, right?
We know very well.
We know very well why consolidation happens and what happens after consolidation, right?
Yeah. And the thing is, if you look at, for one thing, like we discussed, all the green movement has destroyed the industry, but has provided contrarian opportunities, asymmetry for what's existing. And on the other side, just to add to the catalyst, what we have is all this new technology, AI, and we've had crypto and all the energy we need to get this stuff working. You need to run these servers and processors and miners. I don't even know what. Where's the energy going to come from? From the Tesla factory? Are you crazy?
So one of these
are just additional catalysts. These are just
100%.
Add more. I'll add more.
In oil and gas, we do a lot of internal research on these things, and there's tremendous amount of research which went into this data center, the build outs and the consumption, and what is the approximate. I mean, there's approximation for one image. When we write on ChatGPT, it takes around 2 charges of an iPhone battery. So imagine how many we generate these images. It's billions now. So that's why electricity prices are going like this. If somebody sees the long-term graph, they're like this. And so energy is like this. It's down like, it's below it. So there's no enough energy. So I agree with you 100%, man.
Yep, it's all the same thesis. We got it. Good stuff. Thanks. Here, I'll shut the recording here so we can.
Thank you very much.
Yeah, sure. Thanks for adding those points.